Welcome to Street Check, the best, I think it's fair to say, podcast in the history of Cabot Wealth Network, which has been delivering investment insights, ideas, research, and stock picks since 1970. I'm Chris Preston. I'm editor-in-chief and chief analyst of Cabot Stock of the Week. We have a mystery guest today. Oh, wait, no. Who is that?
Yeah, I'm Brad Simmerman. I'm the web editor and chief analyst of the Cabot Wealth Daily. As Chris alluded to, currently not hirsute any longer. That should be resolved in a couple of weeks. This week,
It means he doesn't have a beard. It doesn't have his beard.
Not rocking the beard. It's been 4 years since I didn't have one, and I'm down about 20 pounds since then. So I wanted to see what it looked like. Not an improvement, so I'll be going back to it. This week, we're going to talk about some promising activity in the markets. Obviously, we're going to have to touch on the Fed and see what our expectations should be for rates going forward. And then we're also going to talk about the really impressive rally in Bitcoin in the last month and honestly all year. And then a little bit later in today's show, we're going to have Clif Droke, a gold and metals investing expert, and we're going to talk all about gold, metals, lithium, copper, and what investors should be looking for there.
Yeah, and but first we'll get to your defend the take. Before we get to your defend the take, Brad, as we know, you live in Phoenix. Have you recovered from the Diamondbacks World Series loss, or is this shaving a cry for help?
No, the shaving jinxed it. They lost 3 in a row after I shaved the beard.
Oh, wow.
Yeah, so poor timing.
Playoff beard? Don't you know about that? You're supposed to grow the beard.
It's hockey. That's hockey, Chris. Come on, man.
Yeah.
The Yotes aren't making the playoffs anytime soon.
Red Sox did it one year and they won.
Well, it's just a perpetual bummer being an Arizona sports fan because we get these promising runs that then just seem to peter out and we backslide into mediocrity. The Suns maybe being an exception, but they just got swept by the Spurs at home in a 2-game series, and everybody's hurt and nobody looks particularly good. So probably more of the same. But
I blame it all on the beard loss.
Yeah, me too.
Okay. Yeah, you should. Okay, so let's get to your defend the take. And your defend the take this week is that the yield curve, which has been inverted for quite some time, will disinvert below 5% by year's end. You have 90 seconds. Go.
Yeah, so the yield curve has been inverted since summer of last year, and that, obviously is a portent for possible recession. The Fed isn't really pricing that in per per Powell's comments the other day, but we have seen a lot of progress on the scale of the yield curve inversion, with the 2-year 18 basis points below the 10-year yesterday. Now with the 10 years yield retreat today, it's closer to 30 basis points, but it does seem to be well on its way to disinverting. The two factors that I think are leading or are going to lead to that by the end of the year is bullish market sentiment. We'll touch on that later. Markets picking up steam, and the prospects of maybe a mild recession next year if we feasibly run into temporarily weakening economic conditions. That's going to have more buying pressure on some of the shorter term treasuries, which should drive those yields lower, and optimally it would drive them below the 10-year yield. We've talked about that before. Disinversion is bad if the 10-year rises up above the 2-year. It's good if the 2-year then it just trades lower and falls below where the 10-year is. And that has been sort of in progress for the last 5 months or so, and it appears well on its way to disinverting. And I think if we do get signs of some economic weakness heading into the beginning of next year, that's going to have maybe some downward pressure on rates, because the short-term treasuries become a more attractive investment target when institutional buyers are sort of weighing their option. If they're thinking, okay, well, stocks are maybe overcooked for the next 6 months, I'm going to continue to park cash, I'm going to go for this higher yielding short-term treasury so that I can be more liquid, so that I'm not taking on any kind of additional interest rate risk. If the Fed, okay.
Yeah, I'll let you finish.
Yeah, so if the Fed punts any kind of rate hike decision into next year, if they feel that it's necessary, I do think that the short-term band-aid of the 2-year shorter-term treasuries is going to be a more attractive investment option, and that's going to push yields lower.
Yeah, it's interesting, so when the yield curve inverts, that usually is a sign of recession. Obviously, we have it. You said it was really summer 2022 when it first inverted?
Yeah, it
Wow.
was.
And no recession.
So July
Yeah.
of 22, let's see. Yeah, July 7 of 22 is when it first inverted. And from then until a recession is, I think, typically 18 months. So that would put us sort of right on the door of a potential recession. And the disinversion can also be a harbinger of that. But if we get one, I think it's going to be maybe closer to like the 2001 recession, but equity valuations aren't nearly as sky high as they were at the time. So I wouldn't anticipate a lot of pain for the markets.
Yeah.
I just don't think we got overheated the way that we did back in 2001.
Yeah. Okay. Well, speaking of the market, let's get to our big three. Number one is the market. Very good week, best week for the market easily since the summer. Up S&P is up more than 5.5% as we record this, up every day this week, and it's accelerated since Jerome Powell spoke, which is not something that always does. The other day, we'll get to that in a minute. So signs of life from the market. Earnings growing. It looks like they're going to be up this year, 2.7% average growth among S&P companies through about a little over halfway through earnings season. That would be the first earnings growth in a year, quarterly earnings growth in a year, break the 4-quarter losing streak. How sustainable do you think this rally is? What will make you believe in this rally, I guess, is the question.
The degree of sustainability, I think, is yet to be seen. What would make me more confident in it is if we broke out of this intermediate term range that we've been in since July.
Yep.
We are knocking on the door of that. I've seen talking points that a S&P break above 4,400 is going to be bullish. I would be sort of content with a break above October highs, so more in the 4370s range. Frankly, we could do that today. A weekly close, if we had some strong pressure to end the day, we could get a weekly close above those levels. It would take a good day.
4352 as we record, or as we start recording.
Yeah, so we're not far off, but I don't think we're in a green light right now. I think this is promising signs, but you should still sort of have still be on the lookout for caution flags, just from a technical standpoint. And, job numbers were worse than expected today. We added, I think, 117,000 jobs or something like that compared to 170 expected.
150, but 100, you're right, it was way below expectations.
So it was below expectations, and so I think we'll see some continuing weakness and softness in the economy, which is good for stocks in that it gets the Fed off everybody's back. But I want to see a close outside of that downtrending channel that we've been in since July before I'm calling a resumption of the bull market. It's premature to call it. Give me a weekly close outside the channel, ideally above 4375, or if you are adhering to the Bank of America analysts, 4400 is what they're seeing as the technical levels that we need to retake before the bulls are sort of back in control.
Yeah, we did drop below the 200-day for the first time, not all year, but since the summer rally last week. I mean, this time last week when we recorded last week, if you'd said this is where the market will be a week from now, you'd have definitely taken. You said that sounds amazing. But like you said, we're still just below mid-October highs, and that was down certainly from September highs, and that was down from August highs and July highs. So, we still have some overhead resistance to chew through, as Mike Centola would say. But we're back above the 200-day line at least, and we're actually right at the 50-day line right now. So maybe that's a line to watch.
There's some promising signs with some of the broader indices too. The S&P equal weight and the Russell 2000 both seem to have put in a bottom. in their range, which they've been in since about April. So that doesn't necessarily portend that we're going to start running higher, but it at least seems to set a floor on
Yeah.
equity prices for the time being. I mean, with the earnings season being here, who knows? We've seen a lot of individual stocks blow up. Whether one of those could become contagious and sort of infect the rest of the market is yet to be seen. But I just don't know who is still out there that could come out and really miss
Right.
and
There's no
chop the
Googles
narrative.
out there. A Google
Right.
infected the market about a week ago. Yeah.
Right, exactly. So like the big movers, Apple came out last night and they missed, and I think they're down. They were down in early trade a couple of
Modestly.
percentage
Yeah.
point. Right,
Yeah.
nothing that's game changing. So I do think that there's maybe a little bit of a floor, and I'll be more bullish if we get out of that channel.
Yep. Okay. Well, speaking of reasons behind the market run this week brings to number two in the big three, the Fed. They actually talked this week, and stocks actually went up after Powell didn't say a whole lot, so they didn't raise rates, as I'm sure everyone knows, and no one was expecting it. It does seem his words have changed the calculus, at least among economists, going out the next few months. There's now a 90% chance, according to the CME FedWatch tool, that they will hold rates steady again in December, 85% chance in January, 68% chance in March, with a 20%, the next highest percent chance there is a 20% chance that they will cut by 25 basis points, and only 11% chance that they will raise. This is in March. Do you still believe that there will be more rate cuts ahead, or did what he said or didn't say, or his tone, change anything for you this week?
One of my takeaways was that they were or Powell, sort of speaking for the Fed, was more explicit about letting economic weakness do the Fed's job for it.
Yep.
Obviously, the jobs numbers today help. GDP is going to help if it comes in weaker than expected. One thing that I was a little bit hesitant with was the amount of credit that he was giving to supply demand resolution lag, specifically for jobs numbers. He's still talking about, well, we're seeing this strong employment picture that's all lag from the pandemic, which ostensibly from a hiring standpoint has been done for a year or two. It does make me concerned that they might be slow to the draw the way they were with inflation. I mean, we were talking about inflation for a year while they were calling it transitory, and then it turned out that it was much more than that. So there is some concern that maybe they've either overreacted or underreacted, and we won't know for a year until they sort of clean up their act. But I do think that they're going to let economic data points do as much of their job for them as they can. If we get some surprise GDP growth, if we get signs of a strengthening economy, irrespective of what the Fed does in the next couple of quarters, I do think that rate hikes are potentially still on the table. He used terminology like interventions, right? Instead of signaling potentially one hike, he sort of left the door open for multiple hikes or multiple decisions if the data justifies it next year.
Yep.
We don't have crystal balls. I would guess that they're going to keep the rates the same in December, but I do think it's a mistake to look at the calendar year as if it's some deadline for the Fed to make a decision.
Yeah, that's why I looked into early next year. And while odds do go up, it's not as much as it was, I think, before he spoke. And frankly, just not as much as I was expecting, actually. With 68% being the high going into March of what's expected in terms of them holding rates firm. And I did not expect to see 20% odds of a rate cut. I'd be surprised if that happened before the end of the first quarter next year.
There's also sort of the cynical election year variable, right?
Yeah.
Is the Fed gonna start engineering figures or start making moves to try and favor the party in power, or are they gonna try and be as little of an impact on the economy in an election year as possible? I don't know. I think that maybe does help make the case for some cuts early next year, especially, or maybe in the middle of next year, especially if we get softening economic numbers. For the time being, it feels very wait and see, and hoping that the economy is going to substitute for the potential of a rate hike early this year, and then maybe prompt some rate cuts later into next year.
Yep. Okay, well, let's go on to a more fun subject in the Fed, and that's number three in our big three, and that is Bitcoin, which is up. Quiet rally going on in Bitcoin. It's up. It's more than doubled now year to date, up in the 34,000 range, more than doubled year to date. And a lot of the gains have come in the last month or so. What is behind this rally? So I've always viewed Bitcoin as sort of a bull market play, but the last month, it being up at a time when stocks have struggled until this week, sort of goes against that. So what do you think is driving this?
There's one event that is really bullish for Bitcoin right now, or at least for the crypto space, is a DC federal judge basically slapped down the SEC's rejection of Grayscale Bitcoin Trust's conversion to an ETF. They'd applied for that last year. SEC denied it, and the judge said it was capricious and it was unreasonable because the SEC had approved other future-based products, so something like a BITO, right, which uses Bitcoin futures to sort of synthesize exposure to Bitcoin itself. The appeal date for that decision was like October 23rd. It was in the last week of October or so. The SEC opted not to appeal the decision, so they've got to reconsider it on the merits. They had a closed-door meeting yesterday. I have yet to see any kind of details or reporting around that. I don't know that we'll get anything until a decision is made, but the speculation largely was that they will be discussing that litigation. There was a line item in their summary of topics to be discussed that said resolving litigation. So that's been a big impetus in the short term. If there's an approval of a Bitcoin spot ETF where the fund is just buying Bitcoins and then you're trading it like an ETF, the hope among the crypto bulls is that that becomes a green light for retail investors and institutions to start pouring money in.
Yep.
My fear is that they don't, right? I don't know if crypto missed its moment, if investors broadly and institutions are going to be writing it off the way that we might write off Peloton, right? Peloton was phenomenal during the pandemic, during that froth, during that bubble, and now nobody cares. And that's possibly an outcome for Bitcoin as well. The hope has always been that it would turn into digital gold. And then the fear is that maybe it turns into digital gold and just sort of trades sideways for a while without really drawing a ton of investor interest other than from enthusiasts.
So looking at the broader picture on Bitcoin, I've got the 5-year chart here, peaked at 65,000 in November 2021. So right before the bear market, at least in the NASDAQ, began, right at the top. Dipped as low as 16,000 last November. So extremes, two Novembers back to back. And now this November, it's back up to 34, on the doorstep of 35,000, on the doorstep of its highest point since May 2022. So, basically 18 months. And but still barely more than half of its peak. So would you be a buyer at these levels?
So that's not entirely out of character for Bitcoin. It's had significant sell-offs in the years. It'll lose 80% of its value, and then it'll bounce back and ultimately end up doubling it. If we're entering a risk-on environment, which the market is sort of signaling we might be, I think it's worth a flyer. I wrote a daily recently talking about, if you're bullish on Bitcoin, buying Grayscale Trust on the prospect of an SEC approval of the ETF builds in basically a 10% arbitrage opportunity where Grayscale is trading below the value of its Bitcoin holdings. So if you are bullish on Bitcoin and you wanted to take a speculative play on it, I think Grayscale gives you a little bit of added upside. Even if Bitcoin remains relatively stagnant, there's still some room for appreciation right there.
Yeah, the fact that it topped when the market topped 2 years ago, bottomed right about few weeks after the market bottomed last year, and now is sort of right in the middle when it looks like there's a chance the market could get going. Yeah, makes the case for investing now. But you mentioned it, Bitcoin, sort of the new digital gold. Let's talk real gold here in a minute. We're going to bring on Clif Droke, our gold investing expert, in just a second. But first, as always, if you're watching on YouTube, subscribe, please, or listening on Apple Podcasts or wherever you get your podcasts, 5-star rating. And also, as always, you can email us at streetcheck@cabotwealth.com. All right, let's welcome on Clif Droke, who is a 20-year gold investment expert, gold and other metals investment expert. He's a contributor to Cabot Wealth Daily and Cabot Top 10 Trader Advisory. Clif, welcome.
Good to be here. Thanks, Chris. Thanks, Brad.
Thanks for joining us.
Thanks,
and
Cliff.
It's a perfect time to have you on, with gold at basically $2,000 an ounce right now, up about 10% year to date. But much more so going back a few years. I mean, basically it's just below all-time highs. What has been the driving force behind gold, would you say, both this year and going back even further?
Well, there's three factors that typically drive gold. One, of course, is the fundamental factor, supply and demand. The other is the currency factor, how strong or weak the US dollar is. But the third factor is, I think, largely responsible for what you just mentioned, gold's long-term performance over the last 20 years. And that is I would call it the fear factor / the sentiment factor. And that's basically when gold is in demand as a safe haven, because investors are uncertain about the global economic or the geopolitical outlook, or even simply just the US economic outlook. Can be a major driver. We've been in a 20-year period of just massive global volatility on both fronts. So that, I think, more than anything, has kept gold buoyant in the last couple of decades.
Yeah, up. I think what, Brad, you said like 400 and some percent in the last 20 years. Is that right?
Yeah, 425% over the last 20 years. And I don't know, maybe it gets easy to forget just at our older ages, but we're talking about a sort of post 9/11 world in which global conflict has been rising to levels that we really haven't seen since the 70s. So it's certainly understandable that safe haven attraction is going to be a persistent influence on the price of it over the last few decades. I mean, especially as we see volatility in the markets, we see financial crises. We've had great financial crisis, pandemic, possibly recession, maybe coming up next year or in the next few years. So it is somewhat strange to sort of think about the level of conflict and the level of volatility we've seen in retrospect.
That's exactly right. There's a lot of, in fact, I would like to touch on some of the things Brad mentioned, but there's a lot of things going for gold right at this particular time, which is why I think it's as much a short-term opportunity as a long-term opportunity.
Yeah. What is gold's relationships? Talk about geopolitical conflict, fears, things like that. But also, we're in the middle of this, well, possibly the end of this record Fed rate hiking cycle. Some people believe it's over. Maybe there'll be one or two more rate hikes. But if the Fed is done hiking rates, do you think that is good or bad for gold?
If the Fed is done raking, if they're not going to hike rates, it's good for gold, because that's going to take some pressure off of the, gold competes with treasury bond yields. And if the Fed is done hiking, I think we're going to see treasury yields come down. We've, just in the last few days have seen it. And that is going to remove a major headwind for gold, because, gold is a non-yielding asset, and yield-focused investors are looking at, the higher yields in treasuries. So a more a less hawkish Fed is certainly, I think, good for gold.
What would your expectations be? And I've seen more and more coverage of the U.S. debt levels over the course of the last year, where I think we're projected to be paying $1 trillion in interest by like 2030, right? In my mind, that's going to drive down Treasury. That's going to drive down the attractiveness of treasuries if the US's ability to make repayments or make timely repayments continues to be an issue. What would your expectations be, assuming that we keep our sort of lack of fiscal discipline that we've had over the last 15, 20 years?
I'll be honest with you. I don't really look. I'm not one of those analysts that puts a huge emphasis on U.S. debt because it seems to be a long-term constant, but because it is becoming a headline, people that don't normally talk about it, it's becoming an issue. It will, I think, obviously keep gold buoyant. There will be that additional safe haven demand as people fear the lack of fiscal restraint that you mentioned, the potential for a debt crisis. Yeah, I mean, it's definitely going to feed into the one of the many factors that support the safe haven aspect or demand for gold.
Now, given its run up, the last 20 years, as we mentioned, this year, 10% is pretty mild, but and with it, basically touching all-time highs, some might say gold overvalued in the long term. Do you agree with that?
Technically, you could make the case it is overvalued because the long-term average for gold, I think over 115 years, is $780 an ounce. The last I checked, that's inflation adjusted.
Right.
The latest inflation adjustment for gold price is 1,984. That's pretty close to what it is now, about 2,000. So, that's quite a bit above 780. So is it technically overvalued? Yes, but as we just mentioned, if bond rates come down, that's one of the factors that drives overvaluation for gold or perceived overvaluation. If bond rates come down, if interest rates come down, that will no longer be the case. So I would say the outlook for gold, it looks good because I don't consider gold's technical overvaluation to be an inhibiting factor right now. The rate outlook is looking more benign.
Yeah, it strikes me that in a period of potentially falling rates, and Chris and I, before you came on, we're talking about the Fed's reliance on a softening U.S. economy to do its job for it. I would think that if we do have some economic weakness broadly, if we see job numbers come down, GDP growth come down, that gold's sort of safe haven value would also rise and become more attractive for investors. That flight to safety element, right?
That's right. And I believe I just read the IMF forecast global economic growth will decline from last year's 3.5% to projected 2.9% next year. So there's that to consider. The global economy is in question. So there's a lot of economic factors in gold's favor as well.
And we're talking about the factors that have been driving gold and might prop gold up for a while. What are the best in terms of ways to play it, other than buying bars at elevated prices and hiding them under your mattress? What are some gold miners that you really like right now?
Honestly, I'm not looking. I'm not ready to jump in and start buying the gold miners. Sometimes the gold mining stocks tend to lag, especially in a situation right now where geopolitical factors are driving gold, I think, more than anything. So if I were speaking to potential investors, I would be looking at gold ETFs that hold physical bullion. So, like for instance, the Granite Shares Gold Trust, the symbol BAR. The other, I believe the most actively traded gold ETF, GLD.
Yep.
So I would be looking at a gold ETF, and I wouldn't jump in with both hands and buy heavily because of the short-term volatility. But I think it's something it's attractive right now, and it's got, like as we said, gold's got a lot going for it beyond just the short term.
One thing that you would mention earlier was declining global growth rates. And I'm a little bit curious because you also cover other key metals. I'm most interested right now in what you're seeing in the copper markets. And especially if you have any insight into what we're seeing in the copper markets in relation to Chinese economic growth. One of my interests is that with the data opacity out of China, looking to inputs can provide some valuable insight. So I'm curious if you could maybe tell me a little bit about what you're seeing with copper demand, what you're seeing with that globally, and if you have any insights or any commentary on China, I'd love to hear that as well.
Sure. I don't follow China quite as closely as some analysts do, other than just on a cursory basis. But what I'm hearing is copper demand is diminishing. Of course, they've got property market concerns. Consumer demand in China is also diminishing. So the industrial demand for copper in China and other major industrial countries is less than it was in the last couple of years. And you mentioned copper. It's interesting because one of the ways to evaluate gold is to compare it to the price of copper. They call it Dr. Copper because you can generally evaluate how strong the global economy is by looking at the copper price, whether it's trending up or down. And by comparing copper and gold, you get an idea of how much the demand for gold is relative to copper. Well, right now it's in gold's favor because copper demand is diminished from the last couple of years, and safe haven demand for gold is up. So the copper gold ratio currently, I think it sits at 0.18. That's how much gold is required to buy an ounce of copper. And it's at historically low levels right now. And it's another factor, I think, supporting gold being a good, a good intermediate to longer term investment.
Yeah, and you've written about in the past, and some of our other analysts have written about, especially those who are into EVs, written a lot about the rise of other metals like lithium or other inputs in batteries that drive electric vehicles. Obviously, there's a huge market for that now. What are you seeing there, and is there particular sort of subsector or metal specific there that you like, or is it lithium?
Well, again, lithium has had a bad year.
Yeah.
Lithium and nickel, the battery metals, are not doing well, and it's because of China. It's partly because of China.
Yeah.
My understanding is EV demand in China has diminished in the last.
Especially for Tesla, yeah.
Yes, and so they're not buying as much battery metals, and this, obviously, it's hurt the lithium price. I'm not when it comes to other metals, I'm not a value investor, so I'm not looking at lithium and nickel right now. What I'm seeing, interestingly, is in the energy metals like uranium, which have a lot more upside. I think certainly a lot more momentum. Uranium is at a 15-year high. The demand for uranium in the U.S. among utilities is at I think 11 or 12-year high. Partly because of the energy transition, and there's just a lot of demand for it, and the supply is in question right now. So uranium is something I'm looking at as far as over and beyond the battery metals.
Is there a way, a stock or ETF in particular that you like as a play on uranium?
Sure. My favorite is probably heard of it, it's the Global X Uranium Fund, symbol URA. And then another one is the nuclear, I can't remember the name, the symbol is NLR. But those two are great plays on uranium, just for retail investors.
Both of those, trying to build a narrative around this a little bit. It sounds like increased uranium demand from energy onshoring, coupled with higher gold demand from geopolitical uncertainty and maybe a weakening global economy, seems to be maybe more where you're going from a play standpoint, as opposed to global economic growth, which is going to benefit battery metals, copper, the rare earths. Actually, this is something that I don't know. The rare earth demand, is that typically aligned with growth, or is that something that's going to be more defensive as well, if you have a stance on it or thoughts on it at all.
I believe it's not something that I'm heavily focused on, so I can't answer that from a longer term perspective. But from what I've noticed in recent years, it appears to be somewhat correlated with global economic growth, but more so with the growth, frankly, of the EV industry and of other aspects of alternative energy. So when alternative energy is booming, you're going to see rare earths doing well.
Right. And just to, you mentioned the two ETFs you mentioned for uranium, URA and LR. I just looked it up, both up more than 30% year to date. So been a good play so far, and sounds like it should be going forward. The one metal we haven't talked about yet, silver. I know, silver and gold sometimes somewhat in tandem. Well, it's not quite the flight to safety metal that gold is. What do you think of silver now, and are there any buying opportunities that you like?
Well, they call it the poor man's gold, and it typically it lags gold a lot of times, especially in incidents like this where we've got this military conflict, and that's what's driving, in my opinion, that's what's driving gold in the very short term. Every historical time frame I've looked at where there has been an outbreak of war where the U.S. is involved, silver has always either matched or exceeded gold's performance in percentage terms. The last incidents we have, 2002, the Afghan war, gold was up like 23% in the first 8 months of that conflict. Silver was up about the same. 2003, we had the Iraq war. Gold was up again about 23% in the first 8 months. Silver was up 33%. Now, if this outbreak of war in the Middle East becomes bigger and the U.S. has involvement, I would expect a similar performance for both gold and silver. And speaking of 23%, that's an interesting percentage number because Jason Gephardt of Sentiment Trader has pointed out that based on historical data, when managed money managers turn away from gold, as they have done recently, to the extent that they have, gold has historically gone up by 23% over the next few months, and that happened for only the third time in the last 15 years, this fall. So, if that historical analog holds true, we should see gold getting up to about $2,200 an ounce. That would be a conservative upside objective, and that would be a near-term objective. I'm not saying that's the long-term ceiling, but so that 23% is an interesting. It keeps showing its head in times like this. So that's another reason I'm bullish on gold.
Interesting. Yeah, just looking at the silver chart, you're talking about in times of conflict, how much it jumps. There was a pretty big spike right around the time that the Russia invaded Ukraine early last year. Jumped from 22 an ounce to 26 in a matter of like a month. Yeah, that sort of supports your point there. It could be a reason to, not a fun reason, but a reason to be bullish on silver now.
And Cliff had mentioned a little bit of a lag with the performance of silver over the 1 year. Gold's up 18%, silver's up only 9%. In the last 6 months, gold down 3%, silver down 12.8%. So it would strike me that there might be a little bit more upside if we do see that continuation of the global conflict or expansion of global conflict, or if we see conditions that are still bullish for gold, silver may seem to offer some additional upside there.
I would agree with that. Silver is also has an industrial component, of course, and that's what I think keeps it in a lagging position to gold most of the time. But it goes from being sort of an industrial metal to I don't know if I would call it a safe haven metal, but it follows gold in times of turmoil, as you mentioned. And so if we do see an escalation in military activity, I certainly would expect silver to catch up and possibly exceed gold.
Cliff, thanks for joining us. Always learn a lot more about metals every time we talk, and I'm sure our audience did as well. Again, Clif is a contributor to Cabot Wealth Daily and Cabot Top 10 Traders. You can find some of his bylines on cabotwealth.com site. That's it for this week's edition of Street Check. We will be back next Friday. Thanks for tuning in.